Is it not much anticipated approval of spot Bitcoin being the catalyst? So over time, and finally, all of the innovation research requests for widespread adoption, but they wouldn't actually hinder. As of December 11th, the U.S. Securities and Exchange Commission has not approved any spot Bitcoin ETF applications, despite growing interest and numerous filings from major financial entities. This persisting reluctance stems from concerns about fraud and market manipulation, with the SEC emphasizing the need for a comprehensive surveillance sharing agreement with a regulated market of significant size. Historically, applications for Bitcoin spot ETFs have been repeatedly submitted and rejected. Notable investment firms like ARK Invest, Invesco, WisdomTree, VanEck, Bitwise, and Valkyrie have all faced attempts to launch such products. Despite these setbacks, the race for approval continues, with BlackRock, the world's largest asset manager, recently filing a renewed ETF application. This move has sparked renewed hope in the crypto community, considering BlackRock's successful track record with ETF applications. And then having the Electron Bitcoin would be honest cost, and it really does that, maybe possible, and past that too, on much more effects with a Bitcoin ethmistic, but also sitting in insurance. We've got two patients. We've had patients. Yet Bitcoin, with its unique digital nature and a market dynamic distinct from traditional assets like gold, presents a complex and multifaceted scenario. But let's delve into this intricate narrative, exploring the historical parallels, expert opinions, and economic implications of a world where Bitcoin spot ETFs are no longer a hypothetical, but a former reality. How will this impact Bitcoin's trajectory, and what does it mean for investors, idealists, and the global financial landscape? The history of gold ETFs offers valuable insights into how a potential approval of a Bitcoin spot ETF could impact the cryptocurrency's market dynamics. The first gold ETF, gold bullion securities, was launched on the Australian Securities Exchange in March 2003, followed by the launch of Speeder Gold shares in the United States in November 2004. This marked a significant shift in how investors could access the gold market. Before the advent of gold ETFs, investment in gold was typically done through physical gold purchases or shares in gold miners, which offered leverage to gold prices. Physical gold, however, had several drawbacks, such as sales tax, storage costs, and regulatory constraints, making it less accessible to the average investor. The introduction of gold ETFs democratized gold investment, offering a more straightforward and cost-effective way to invest in gold without owning it physically. This ease of access played a pivotal role in increasing gold's appeal to a broader range of investors. The impact of gold ETFs on the market was substantial. The gold price, which had been in decline from its peak in 1980, began to rise steadily after central immigrants' bank selling stopped, and that was removed on physical gold purchases. Following the launch of the first gold ETF, gold prices experienced a significant increase. Between 2004 and 2011, gold price soared from around $450 to more than $1,820, marking a nearly 350% increase. Drawing parallels to Bitcoin, the approval of a Bitcoin spot ETF could potentially have a similarly transformative effect. A Bitcoin spot ETF would provide direct exposure to Bitcoin's price, making it more accessible to a wider range of investors, including those less inclined to navigate the complexities of cryptocurrency exchanges or digital wallets. This increased accessibility could lead to higher demand and potentially drive up Bitcoin's price. And however, it's crucial to consider the differences between gold and Bitcoin markets. Bitcoin's market dynamics, regulatory environment, and investor profile differ significantly from those of gold. While history can provide insights, the impact of a Bitcoin spot ETF could manifest differently due to these unique factors. Nittengauer global head of digital asset and technology design at State Street, opines that Bitcoin ETFs could usher in a transformative era for Bitcoin's market dynamics. And he says even after the approval of Bitcoin ETFs is not just a regulatory milestone, it's a gateway to unprecedented capital inflows into the Bitcoin ecosystem. Post-approval of these spot Bitcoin ETFs, we could witness Bitcoin's price soaring past $60,000 levels by the next halving event. And Gower also emphasized the broader implications beyond the price jumps, focusing on how Bitcoin spot ETFs could fundamentally alter Bitcoin's long-term viability and acceptance in the financial ecosystem. At this point, this isn't merely about price increments. It's about legitimizing Bitcoin in the eyes of traditional investors and accelerating its journey to becoming a mainstream financial asset. Meanwhile, Hubertus Hofkirchner, founder of BitCredit Protocol, offered a nuanced perspective on the potential impact of Bitcoin spot ETFs. The excitement around ETF approval embodies the dichotomy within the Bitcoin community. Idealists championing a new monetary paradigm and investors eyeing price appreciation. While an ETF could indeed APS defense box, we see a few propel Bitcoin's value. Due to increased scarcity, idealists worry about amplified volatility, undermining Bitcoin's adoption in the real economy. Beyond their solutions in the adapted market 1540s, I was doing all over 26 in a matter of Bitcoin for a while. We set that Bitcoin might be set as a great message to the same experience to this deal is a difference. This volatility fueled by speculative trading often associated with ETFs could undermine the very attributes such as stability and reliability that make Bitcoin an attractive alternative to traditional currencies. And he also pointed out the contrast between Bitcoin and traditional commodities like gold, noting that Bitcoin's unique digital attributes differentiate it significantly from physical commodities. Unlike gold, Bitcoin's digital nature eliminates the logistical challenges of physical commodities, which might render the allure of a Bitcoin ETF less compelling than it was for gold. Consequently, the primary appeal of a Bitcoin ETF lies not in addressing logistical challenges, as with gold, but rather in offering a regulated mainstream financial instrument for Bitcoin investment. Turning to a critical viewpoint, Peter Schiff, a well-known skeptic of cryptocurrencies, offered a starkly different take in his recent tweet. Pulling back below $2,100 has provided a catalyst for a spike near 41K. This could be Bitcoin's swan song. The speculative frenzy around spot Bitcoin ETFs will end soon. Bitcoin's collapse will be more spectacular than its rally. In contrast, gold's rally is real. And Schiff's perspective embodies the skepticisms some traditional investors hold regarding the sustainability and real value of Bitcoin, especially in comparison to traditional assets like gold. And hence, while some Bitcoin ETFs are a game changer that could significantly boost Bitcoin's value and mainstream appeal, others caution about potential volatility and the contrast with traditional assets. And while crypto enthusiasts are excited about the introduction of Bitcoin spot ETFs, believing it could increase Bitcoin's price, it's essential to distinguish between price and value. And the ease of trading an ETF could indeed attract new demand from those who find owning Bitcoin directly cumbersome, potentially raising its price. In the near term, however, that does not inherently improve Bitcoin's underlying value. From an economic standpoint, the concept of a negative sum game is crucial in understanding the potential impact of Bitcoin ETFs. And in game theory, a zero-sum gain is a situation where one participant's gain or loss is exactly balanced by the losses or gains of other participants. Bitcoin, when viewed through the lens of trading and investment, can be likened to a negative sum game similar to poker in a casino with a rake. Here the winner's gain equals the sum of losses from other players, but additional costs, the rake, like trading commissions, margin interest, and promotional expenses, create a net loss system. The introduction of ETFs potentially increases this rake. While it might streamline access to Bitcoin, the additional layers of fees and expenses associated with ETFs could exacerbate the negative sum nature of the investment. This is particularly relevant if the ETF structure does not add intrinsic value to Bitcoin, but merely offers a more convenient investment vehicle. In such a market, only highly skilled traders, similar to professional gamblers, might profit, primarily during times of high influx of inexperienced traders. However, this is not sustainable as less experienced traders exit the market after losses. The competition among skilled traders intensifies, making it harder to overcome the increased costs and maintain profitability. Moreover, the introduction of Bitcoin ETFs could impact Bitcoin's decentralization ethos. While ETFs might bring Bitcoin closer to mainstream financial systems and increase its adoption, they do so by integrating it within traditional financial structures, which may be contrary to the original decentralized anti-establishment vision of Bitcoin. In conclusion, while Bitcoin spot ETFs might increase the cryptocurrency's price and mainstream appeal in the short term, they introduce complexities that could affect its long-term economic sustainability and philosophical ethos. And the differentiation between price increase and true value addition is critical in assessing the potential impact of these financial instruments on Bitcoin's market dynamics.